Hello and welcome to the Morningstar series, Why Should I Invest With You? I'm Emma Wall and I'm joined today by Mark Williams, manager of the Liontrust Asia Income Fund. Hi, Mark.
Hello.
So I thought we'd start with a big topic of this year, and that's energy. I noticed you have a number of energy and basic material names. Does that mean that you're positive on the energy sector?
No, not the energy sector in its entirety. We do find some opportunities, but they tend to be very much stock specific. So within the companies that we own BHP, and that's much more to do with it stopping its investment in CapEx and starting to potentially throw off significant free cash flows. And they have, since we invested, actually been more aggressive with their iron ore pricing, which has been a negative. But we think over the medium term, that's going to be a very strong player. And some of the smaller competitors are going to fall out of that market, probably. So that would be one example. Another one would be China Hongqiao, which is an aluminium producer in China. And there, again, for their own specific reasons, they have an advantage in that they've got direct access to electricity. So they've got, as one of their largest costs, about a 10% advantage from a lot of their competition. And they've got much more modern plants than some of the international competitors.
And because of that, those two names can fulfill the income part of the name of the fund?
Yeah, so we're definitely targeting companies not just for income, but for a combination of income and growth. And we think over the medium term, both of those fit that very nicely. And
you mentioned there China. I know that you're very positive on China, which is perhaps contrarian viewed compared to some other investors within this space. 42% of the portfolio is invested in China. Right. What do you say to the naysayers?
I think, for me, it always comes down to fundamentals. And yes, there's been a significant sell-off, particularly in the A shares, and we don't invest and haven't invested in any of the A shares. And in the Hong Kong listed companies, that's where we're finding the opportunities. And we think trading less than 8 times forward earnings with double-digit earnings growth still likely to come through over the medium term, that looks like a great opportunity. And we don't like what the government has done recently with its intervention in the A share market. We're disappointed with that. It's definitely a medium-term negative. But overall, what China has tried to attempt in its transition away from poor investment for production, particularly low-end manufacturing, much more towards a services-oriented economy, we still think that in general, despite the recent setback, they're heading in the right direction. And so with that in mind, we don't think that there is likely to be a financial crisis driven from the significant sell-off in the A-share market. And without that, again, we look at valuations and find some of the best opportunities within the region. But you've got to bear that in context. We're not entirely positive on China. We do understand that there will be some negatives as they make this transition. It will be difficult and there will be volatile because of that difficulty. But overall, they still seem to be doing pretty much what we would like to see them do.
And then perhaps moving south in the globe, I know another area that you have some exposure, but perhaps are looking to move away from is Australia. There have been some headlines recently to say that Australia is getting, its stock market is looking overvalued. And you do share that view, don't you?
We do. I don't say we'd be looking to move away from Australia because we've been fairly negative since we launched the fund about 3.5 years ago. But we do think there are significant headwinds that are going to cause problems in Australia. And one of those is the fact that you've, because of, as I was saying about BHP, not got the same CapEx investment in mining. That will have some knock-on effect or multiplier effect on the economy. But apart from that, it's also got a very expensive property market, a significant amount of household debt, and some competitive disadvantages for the retail environment. So all of these things give us some negatives, and at the same time, it is one of the more expensive markets within the region. The companies themselves are well managed. We do find opportunities, and the ones we're invested in we like. And should you continue to see a sell-off in the equity market and valuations became more enticing, then I think we'd be more likely to invest in it. But overall, at the moment, when we compare it, it's trading at roughly 100% premium to the Hang Seng listed Chinese companies that I mentioned before. And that is one of the reasons why we're not taking that risk at the moment.
Mark, thank you very much.
Thank you very much.
This is Emma Wall for Morningstar. Thank you for watching.